Welcome to Module 6, the Income Statement. I am Donna Gady, a farm business and production management instructor at Western Technical College near La Crosse, Wisconsin. One of the main parts of my job is to work with farmers to determine what their financial picture looks like and to track that picture to see if it is heading in the right direction. There are two worksheets that go along with this module, the income statement. Please have these worksheets by you as we go through the training. The first says balance sheet at the top, and the second says income statement. In this training, we are going to go over several things, including what does an income statement tell you, as well as what is the difference between cash and accrual recording, and how does the income statement reflect this. We will also look at recording income and recording expenses, accrual adjustments, net profits, depreciation, and what can you learn from an income statement. So what is an income statement? It really tells you if your farm or your operation is making a profit. Did the business generate an adequate return on investment for all of your money invested, all of your time invested, and for your labor? In the end, we get the net farm income. Are you in the red or are you in the black? But it really does come down to net farm income. The income statements are divided really into two different areas, the revenue and the expenses. And we include both cash and non-cash items. It is important to look at those non-cash items. They will make a big impact on your income statement. Before we dig too deep into the income statement, first we're going to talk about cash versus accrual systems. On a cash basis, income and expense is recorded when cash changes hands, whereas on an accrual basis, income and expense is recorded when the item changes hands or the labor is done. Cash versus accrual is usually easier to understand with actual examples. Custom work is a great example to use. On a cash accounting system, the amount owed for baling this field would be recorded when the bill is paid. In an accrual system, the amount due would be recorded as soon as the work is done. So if on occasion that bill would not be paid until after the first of the year, in a cash system, this bill would go towards the next year's expenses, which is not exactly accurate. This is one of the main reasons that our income tax returns are not necessarily a good picture of how a farm is doing. Income taxes are usually done on a cash basis and do not account for large bills that are owed at the end of the year or for large bills from previous years that were paid off during that year. We will talk more about making accrual adjustments in a little bit. In order to develop your income statement, there are several things you will need before you even get started. First, the beginning of the year balance sheet, that January 1 for the year that you're planning on looking at. The end of the year balance sheet, either the December 31st for the year you're looking at or the January 1 for the next year. And then any bookkeeping records that show all of your income and expenses as well as some of your account balances. Before we get started, look at the worksheet that was given to you. You can see that the balance sheet worksheet is one that you should have completed before you do your income statement. This worksheet is nice because you can list the 2 years, or the beginning of the year and the end of the year, right next to each other so you can see the differences between beginning and end. Feel free to pause this training and complete your balance sheet, both the beginning and the end of the year, before proceeding with your training. Once your balance sheet is complete, we will be moving on to your income statement, which is the other worksheet that is in your packet. As you can see on that worksheet, the first thing there is your cash farm income. We count these as your farm revenues. Revenues are any ordinary cash received, sale of farm products, custom work, any government payments, the sale of raised or purchased livestock, and any crop insurance proceeds. Please do not include any sales of capital assets like land or machinery. I will show you later where we will put these on our balance sheet and income statements. So for instance, this would be the revenue for a farm. corn sales, milk sales, the sale of any cull breeding stock, and any other miscellaneous livestock income. Any government payments are also included in this section. So by this, you get your gross farm income. If you look towards the bottom of your income statement, you will find the heading Accrual Adjustments. We have both accrual adjustments for revenue and expenses. We are first going to address the accrual adjustments for your revenue. In revenue accrual adjustments, we're mainly talking about inventory changes, the changes of inventory of both crops and livestock on the farm, and any change in the accounts receivable. So in order to figure these out, we have to look back at our balance statements and see if we have changes between the beginning of the year and the end of the year. So if we look at this example of a balance statement or a balance sheet, it is simply the difference between the first year and the second year. The main ones on this one are, you can see crops, the beginning of the year, how much we had in a crop inventory, and then the end of the year, and there is a slight change. We also have a change in machinery, but we do not include these on accrual adjustments. So for instance, in this farm we had a crop and a feed inventory difference of $1,156, more at the end of the year than the beginning of the year. Now, accounts receivable can be a little different. Accounts receivable, if you remember, we had a difference in accounts receivable. At the beginning of the year, we started with $3,000. We ended with $0 in accounts receivable. No one owed us any money at the end of the year. This is a $3,000 difference, but it actually went the wrong direction. So, in our income statement, we're going to want to record this in the parentheses, meaning it's a negative number. So we will actually subtract this from our income. One of the nice things about doing these numbers and getting these calculations and these reports is being able to come up with some information that we don't necessarily have on the farm or we don't take the time to calculate. So for instance, do you know how much feed your animal or animals eat per year? You can actually calculate this using your balance sheets and the difference in feed. So if you look at this example, at the beginning of the year, in the beginning column, we had 6,600 bushels of corn. The next column shows that we produced 14,400 bushels. We could also put any corn that we purchased in this column. We sold 5,600 bushels, and then if you ignore the fed part and know that you just had 6,602 at the end of the year, we could do a backwards calculation and figure out that we fed 87,098 bushels of corn. It's nice to have these numbers because then when we're planning for the next year, we can always plan for how much we used the year before, or if we have more animals, be able to increase the number we have in storage. This is especially important for those hay and corn silage crops that you really need to know that you have enough before you go into the winter. We will now be moving on to the expense side, or the expense area of our income statement. These are usually the ordinary cash expenses we think of on the farm: feed, seed, fertilizer, any labor expenses that you might have, and then the interest paid on the farm debt. Please note on interest, it is the interest paid on all farm debt, not just your real estate loans. Real estate, machinery, livestock, even feed and seed, and especially include those high interest accounts at the feed mill and those farm credit cards you may have. Don't put this amount toward feed or seed. If you do, you will not have an accurate account of your feed expense. You did not buy feed with those interest payments. You paid the store to give you credit. Just as a reminder, do not include purchase of capital assets like land and machinery on your expenses on your income statement. These are actually recorded in a separate section, so don't put them in there. Let's go ahead and move to that confusing thing of accrual adjustments. On the expense side, there are several things we will adjust for, including including the value of growing crops, prepaid expenses or supplies, accounts payable, and depreciation. So on this example, we did have a change in prepaid expenses and supplies of $1,000. Now remember, it's in the parentheses, so it's a negative. We actually started this year with more prepaid supplies than we ended it. So this could be $1,000 worth of seed that we started the year with $1,000 worth of seed and ended the year with no seed in our barn at all. Remember with growing crops, if you start the year with no growing crops and you invest and decide to put a crop like a cover crop in that you would have an expense for but would not actually be able to harvest until after the first of the year, we will use an amount in this column for those growing crops. This is usually just the cost to get them to that point. So any seed or labor or fertilizer to plant that crop. The other thing is accounts payable. This is one that we hope goes from 0 to 0. This is really those bills that you owe that are past due. So if you remember our example of the custom harvest of the hay, accounts payable would have an amount in it if we didn't pay for that custom work by the end of the year. Again, we would like this to see this go from 0 to 0 and have no change. Before we move on, I want to go through the entire income statement that you were given on your worksheet. This income statement was actually developed by Moses, so you'll have to bear with me. There are a couple typos on it, but I am not the one that created the income statement. It has been around for several years. We start out with the cash farm income. Make sure you include any of those farm income sources. For instance, many people I see forget those co-op dividends that they get at the end of the year, or they sell a few eggs from their chickens and they don't record those, or they sell a few things off the farm. Remember, this is not what we're giving your tax man. This is what we're doing for your resources. So make sure you record everything that you sell. If you forget to record that one load of hay, it may not make a huge difference in your income statement, but it may make a difference when we start calculating what your yields were on your hay fields and we forget about that load of hay. We then move on to the cash farm expense. Again, list everything that you can think of. Some of the ones on here that I notice that people forget are those certification fees. The other thing that's not listed here that you should include are any legal fees, whether it's tax prep, somebody might pay the lawyer to create an LLC or to put land in the trust. The other thing is any expenses you have for education. Some of you participate in a program. You, for instance, this webinar or other ones may have a fee on them. Make sure you record those expenses because those are tax deductible. We move on and we do the accrual adjustments. You can also see that depreciation is not included in those accrual adjustments on this worksheet. It actually has its own separate category. Make sure you use those depreciations for machinery, titled vehicles, and then of course your buildings and improvement. Again, that's a good reason to not have buildings and improvements with your land on your balance sheets because we do depreciate buildings and improvements. You may ask, why is titled vehicles separate from machinery? It really is simply, a lot of times our titled vehicles do not last as long as our machinery, so we depreciate them faster. On your income statement, you also see at the very bottom there's a capital adjustment. We will talk about this in a little while. If you are completing your own balance sheet and income statement, as we are working through this, now would be a good time to pause the webinar and complete your income statement, including calculating those lines that say net cash farm income and net farm income at the bottom. We will talk in detail about what net farm income from operations means, but on your income statement, remember there is just the net cash farm income and net farm income. So feel free to pause this webinar until you've completed those for your own information. Now that you've completed your own information, We're going to look into what these terms mean and how to calculate them, or what they should look like on your farm. The first one is net cash farm income. You can see on your income statement, it is at the bottom of the first few sections. After the gross farm income, we have gross cash farm expense, and then the net cash farm income. The net cash farm income really tells us how the farm is doing on a cash basis, not on an accrual basis. Some farms don't do very well on a cash basis because they spend all of their cash on building equity. Other farms do well on a cash basis, but not so well on a total overall basis because they don't replace machinery and they don't have increased equity, but they may have cash. We will talk about these values in future webinars. After we've gotten the net cash farm income, we add in all of those accrual adjustments and we get our net farm income. These are all income and expenses from the farm. It includes all of those accrual adjustments that we make based on the balance sheets. So for instance, if we are talking about capital purchases, for this example, the farm purchased a chopper box for $8,000, but sold a tractor for $6,000. That means the net capital change is $2,000. Did this farm necessarily make $2,000? It would have in cash, but if that chopper box was only worth $6,000 and we spent $8,000, and that tractor was actually worth more than $6,000, if you really look at the beginning and ending balance sheets, you will notice there's actually a decrease in our machinery investment or machinery equity. So even though we may have made $2,000 in cash, the farm actually lost money or lost equity on these decisions. Net farm income from operations is really taking away that what I just talked about capital purchases. It really is the cash farm income, the cash farm expenses, and any inventory changes, but really does not take into account that capital adjustment at the bottom, which is $2,000. It's accrual adjusted gross revenue minus the expenses. It's really any income generated as a result of normal day-to-day work on the farm. We don't count purchases of capital like land and machinery as day-to-day work on the farm. Throughout this module, we have learned several things, including what an income statement really tells you. It is your net farm income. How does the farm look profitably? You should have a better understanding of the difference between cash and accrual recording systems. Remember, accrual is a better picture of how the farm is doing. You should also see the importance of accurately recording income and expenses, not just when you paid them, but when that expense or income was received. We also went over accrual adjustments, the importance of making those adjustments so the true picture really can be seen. And the net profit. Is the farm profitable? That really is the most important. And what kind of profit are you looking for? Some of the other modules will explain this, but are you looking for a cash profit, or are you trying to grow your equity, which may not show up as a cash profit, but just an increase in net worth? We also talked about depreciation, the difference between an actual depreciation versus what is reported for your taxes. And then we talked about what you can learn from your income statement. All of these things are important when considering your income statement and looking back over the one you completed for your farm. If you need additional resources, there are many things you can look at or many people you can contact. The first is usually your lender. The lender at your bank should be able to help you look at an income statement and may actually ask you for it when you're asking for more credit. Your accountant can also give you more information, as well as your university extension office in your county, whether that's the local agent or a university resource. For instance, in Wisconsin, we have several resources at the state level, including the Wisconsin Farm Center, which also helps with doing financial statements and things like that. And many states have a farm business and production management program whose instructors can help you one-on-one putting together those financial statements you're looking at. If you need more information on where to find these resources or the Farm Business and Production Management Program in your state, feel free to contact me at the information on the screen. For more information about farm finances, listen to the other modules that are available for this course, the Fearless Farm Finances course.